Opinion: this is the real reason why the US economy isn't in recession danger now. The yield curve is first and foremost predicting the outlook for Fed policy rather than the next recession. My research has in my recent book, I wrote the yield curve model is based on investors' expectations of how the Fed will respond to inflation. It is more practical. More specifically, after studying the relationship between the yield curve and the monetary, credit, and business cycles, we have concluded that it is the yield curve is just keeping score on how the Fed is reacting to and influencing these cycles. So why do invert? According to a July 2018 Fed study about the yield curve, the probability of a recession was around 14%. However, the Fed recently signaled that they're in only one next year. If so, this one. Original note: the authors stressed that the long-term spread reflects the near-term spread, which they argue makes more sense as an indicator of a recession that is expected to occur within the next few quarters. They also observed, at the time, their assessment was that the market is putting fairly low odds on a rate cut over the next 4 quarters, i.e., 14.1%. Unlike far-term related video Jim Cramer on why investors should pay attention to the yield curve provided by the street. 2. Updated study. In addition, they report its predictive power suggests that, when market participants expected and priced in a monetary policy easing over the subsequent year and a half, a recession was likely forthcoming. The near-term spread. 3. A highly hedged. Indeed, figure 3 in the study clearly shows that recession risk jumped to 50% based on first quarter 2019 data available only through January. Interestingly, accordingly, we're not freaking out about an impending recession. We are focusing on the yield curve. Spread tends to narrow during periods when the Fed is raising the federal funds rate. It tends to bottom. It might be different this time, if the Fed has paused on a timely basis from raising interest rates any further, thus reducing the chances of a recession. After all, hence our conclusion that it is credit crunches that cause recessions, not inverted yield curves and not aging expansions. 4. False positives. 5. Missing in action. According to Haver Analytics, our data vendor, we had been in touch with the board about the 0 to 6 quarter forward spread earlier this year, and they had told us they calculated it using an internal fitted zero coupon curve in quarterly maturities. They only make 6. The 2-year yield. 7. Pause prediction. The Fed study suggests to us that the spread between the 2-year Treasury yield and the federal funds rate may be the simplest way to track the fixed income market's outlook for monetary policy over the next 52 weeks. Anyone can do this. The bottom line for now, we still don't see a significant risk of a recession, especially since the FOMC remains patient. The committee's recent Ed Ayardini is president of Ayardini Research, Incorporated. Melissa Tagg is more a.
Raindrop, drop top, top smoking, no cooking the hot pot. Fucking on your bitch, yeah, that. Looking up, open the park pot.